Hello Proponomics people and welcome to the Sunday supplement from April the 7th, Sunday 2024. Now, I usually record this as an audio file, which I've already done. It's gone out on the podcast platforms, but very frustratingly it won't seem to upload to the YouTube as the normal audio file. So I managed to carve out a little bit of time while Sunday dinner is cooking just to read this one for you live on video. So please excuse me if my eyes are wandering across the screen, but I'm trying to read it off in the best way that I can. So I've called this week's Train on the Tracks ? Because you'll see as it unfolds, but basically there were some quite negative prints, especially from the Halifax on house prices in the UK this week for the month of March, and I thought I'd better address them head on since I've been going on about just quite how bullish I am over property prices in the UK. So, as you'll know, if you listen regularly, I like to start with a quote, and this week's is "Difficult roads often lead to beautiful destinations." And that's from Zig Ziglar, the American author. So before I get started, some exciting news about the 27th of April. That's the day, first in a series of events this year, that Partners in Property are going to be running on social housing events that are live and in person. 7 speaker slots in total, covering every aspect of social housing. Attendees will be able to walk away with all the nuts and bolts they need to decide whether they want to incorporate social housing within their own property portfolios. The agenda will include why Sue Sims started in social housing as an investor more than 8 years ago. We'll also have Wayne Millward, the founder of Room Match, outlining all the due diligence you need to undertake when deciding on which social housing provider to work with. We'll have Mark Turner, the Chief Operating Officer at the Housing Network, who'll be talking about the future of social housing. We'll have a social housing expert mortgage broker confirming exactly what you need to provide and take into account when you're looking for funding for social housing. And then we'll have Pinder Dhaliwal, the MD from Falcon Insurance, who'll give you an overview on how to ensure that your property is insured properly if you lease it to a social housing provider. We're currently on early bird tickets at the moment, so hopefully you can go and grab one of those at the Partners in Property website following the event links. Thank you. So, welcome to the supplement. It's our second short week in a row thanks to Easter, because that's how it works. And it felt more like this week where everybody tries to pretend there are 5 working days when really there are 4. It was a bit of a catch-up week at my end because we've had a little bit of flux in our internal team at the HQ of our group operations. And it's been a challenge, but an enjoyable challenge. So Macro had a busier week than last week, and it wasn't all roses this time out, which led me to reach for that different title. Are we on track for this great purple patch, or have the bears had a great week and is the train off course? We've got to discuss the Halifax and Nationwide house price indices. The purchasing managers indices were also out, which are always worthy of discussion. You know, I like those as real-time measures of what's going on in the broader economy. Mortgage approval rates, and I go into much more detail about the Bank of England money and credit report for the month, because we need that deep dive into exactly what's going on with money and credit. And in the least surprising news since man lands on moon, the bond and swap yields also get some airtime. So, the house price indices. I've been at the mouthpiece of that megaphone over the extensive growth since the start of 2024. And most of that, according to Halifax anyway, has evaporated in 1 month. It's almost like they're trying to hit their own target of 4% down for this year. I'm only joking. 1% down in a month though, which was their print, is significant. Nationwide were less bearish, but their minus 0.2% was still 0.5% under the consensus view. What happened? Well, we must remember their figures are based on loans issued quite heavily. Their own data, whilst they're massive lenders, is only a relatively small percentage of a crowded market, even Halifax. Nationwide's data will be more skewed towards investors and buy-to-let because of their ownership of the mortgage works. On the face of that, you'd say that investors have been somewhat active, whereas resi punters less so. When you compare it with the real-time sales agreed data, of which Christopher Watkin is a great source and distributor if you don't already follow him on socials, this doesn't look to add up. March was a good month for sales agreed, an improvement, 3% or so in terms of the prices of sales agreed per square foot, which is the best metric of those readily available, compared to the end of 2023. So why the incongruence? It's not easy to say. No data is perfect. All of those are real-time stats rather than the Landridge, which will update in about 4 to 5 months' time to reflect all this. So we know the ONS is going to be up about 3% compared to the April-May print in about July/August, because that's how much prices move forward in Q1 in terms of sales agreed. But what did Halifax themselves say? Well, firstly, they still printed a plus 2% for the quarter, so we wouldn't be overly worried by 1 month's print. They're citing affordability concerns, which I disagree with, to be honest. but also a change in the expectations of when rates are going to come down, which may have some truth in it, although why hang on if rates aren't coming down as quickly as expected? Strangely, they've also, in the face of a falling month, completely changed their rhetoric. They now cite a more Zoopla-esque style of a limited scope for significant house price increases this year. Need I remind you their forecast is 4% down for the year, or it was. They seem to already be at the stage where they're disowning that. There is some good sense in there though. Demand is positive, mortgage approvals are up to the 10-year average, prices won't change massively whilst interest rates stay high. They're still making the same mistake as everyone else though by not having inflation in the conversation. Before writing this section, I was listening to The Rest is Politics with Alistair Campbell and Rory Stewart, talking about some universities going bust or being close to it. It's a super podcast. Even Rory had no concept of what inflation had done since 2010. He estimated it at about 30%, when the reality is 60% if you take some kind of halfway house between CPI and RPI. Inflation blindness is a thing, even for someone as well informed as Rory. It's inflation that will continue to help drive things forward. To have this discussion in early April without the context of the massive increases in disposable income that particularly lower paid households are seeing in percentage terms, but all working and pensioned households are seeing in absolute terms, is just silly. So I'm comfortable we have very little to worry about. Based on my logic, March's ONS print will be based on deals agreed in November or so last year. A different environment indeed, but I doubt it will be a 1% down month. One wobble can be forgiven, is basically what I'm saying. What's being conflated is the fact that this week's mortgage offer data release was based on what happened in February, not March. So when the early May Bank of England money and credit report comes out, we can expect mortgage approvals for March to have dropped right back to the low 50s or similar. Talking of mortgage approvals though, that made plenty of headlines. What was the number? 60,383. It's above the magic 60k, which as stated is the 10-year average. I personally would be happier to see it up at 65 or 70,000 as that looks like a healthy and growing market. But that's a bit of a pipe dream with interest rates still at the levels they are. That's going to take a bond yield for the 5-year at around 3.25% or lower with some stability, I'd say. Still, the consensus was a similar print to January's number of just over 56,000, and it was a nice surprise to see the 60k mark breached. It generated a lot of positive headlines, which will largely be undone in a month's time as per what I've said already. Still, what it means is that the market could cope with rates at or around 4% for the best buys on the 5-year in the resi market. All of the tricks from the toolbox, higher arrangement fees, longer terms, interest-only periods and a few more, have worked to keep the market relatively healthy, and credit, no pun intended, should be given where credit is due here. The regulator has done a very decent job since 2009. Yes, it was woefully inadequate before that, but blaming one single party or actor is not feasible. They were all at it, and it rarely, very rarely receives any public praise at all. I'm going to go deeper into the money and credit report shortly, so suffice to say good news, but temporary good news, and I expect the direction of travel to reverse again next month and leave a few scratching their heads, which they shouldn't really be doing because we don't yet, until rates do work their way down, have all the ingredients for a crack-up boom. Inflation will drive prices forward though, I say again. So on to my darlings of real-time statistics, the Purchasing Managers Indices, or PMIs. The PMIs look healthy. Services has had its wings clipped slightly for March to 53.1 from a 53.8 print last time out. Slightly under consensus, but just the right side of that very healthy 53. Construction and manufacturing both limped over the 50 mark, which is good news. The effects of the construction inflation situation and the manufacturing bubble that deflated quite significantly after PPE and COVID look to have worked their way through the system. This will still hurt housing starts for many months to come in my view, and some reality needs to set in regarding pricing. The composite index thus printed 52.8, which compared to the previous 53 is a tiny step in the wrong direction, but nothing to be concerned about. It cements Q1 as a growth quarter for the UK economy in my view, as I've seen nothing from the more real-time stats and surveys to suggest anything else. March could well be a flatter and more disappointing month, but February should have done okay. We find out later this month. And something like the 0.4% print I've suggested for Q1 GDP should be what comes back. There'll be more PMIs in a few weeks when they get the April flash numbers. On to the ever-presence then, the bond and swaps market. Only 4 trading days again, and it was, as I said, a tougher week. We gave up most of those gains from a couple of weeks back as the yield hardened from 3.832 at the open to 3.936 at the close of the week, with a couple of peaks above 3.95, approaching that 4% number again. I did say last week that those market moves suggested very slightly that we move up again before we move down, slowly, and that sadly has come to pass. Still, we can't mourn 0.1%, well, we can, and I am, but it is the direction we want to see, let's face it. The positive economic news allows the yields to harden because it doesn't look at all critical that rates are dropped at the moment. The system is working as far as the Bank of England sees it. So the swap's 3.82 on Thursday's close on the 5-year SONIA. That mortgage market money without any profit margin or operational costs supplied, remember, which is still trading below the market in the 5-year gilt, which closed at 3.885 on Thursday. Supply of money is still exceeding demand, and it still remains to be the case that rates need to get a chunk cheaper before demand for money exceeds supply again. Or the property market needs to hot up. But it will only hot up if interest rates are lowered, unless there's an external incentive such as a stamp duty holiday or other fiscal intervention by the government, which looks unlikely at this point in the Parliament and the year. Okay, on to the main course then. Well, firstly, it'll be the fish course, which is the Bank of England's money and credit report. A monthly fixture, but one I only tend to tuck into about once a quarter, because not enough really changes within a month. But I thought it was worth a revisit here as we've entered quarter 2 of 2024. So they're bullets first with some commentary from me. Individuals borrowed on net 1.5 billion of mortgage debt in February, compared to 1.1 billion of net repayments in January. We knew an improvement was coming as the rates had dropped nicely, and it took the world a couple of weeks to wake up in January 24 as usual anyway. Net mortgage approvals for house purchases rose from 56,100 in January to 60,400 in February. Net approvals for remortgaging also increased from 30,900 to 37,700 during this period. Well, it's good news on mortgages, as I said, to the 10-year average. Not quite healthy as yet, as that's more like 65 to 70k a month, as I said. A significant improvement on remortgages, a 22% increase, as people stop waiting and accept that the rates are where they are, maybe. The effective interest rate, the actual interest paid on newly drawn mortgages, fell by 29 basis points to 4.9% in February. That's a big drop as well, making a significant difference. Far better than the average rate in the market at the moment, which is more like 5.25. The fact that people had products secured and then were able to trade down their rates as they neared completion will have helped with this. I'll be interested to see March's figure, but this is well in the money versus the 5.5% magical stress test rate that the vast majority of mortgages have been stress tested at since 2012 in the Mortgage Market Review, as I've referred to a whole number of times for the past couple of years. Net consumer credit borrowing decreased to 1.4 billion in February from 1.8 billion in January. I wouldn't read too much into this. There'll always be extensive consumer credit borrowing in January to plug gaps left after Christmas, so perhaps reserve judgment until next month. UK non-financial businesses repaid on net 3.3 billion of loans to banks and building societies in February, compared to 0.2 billion of net repayments in January. This seems interesting. I always caution against analysing 1 month's movement too heavily, but I have to balance that against trying to be as real-time as possible in my analysis in order to make it useful. This repayment says two things to me. One, companies are not finding investment opportunities that offer them a better opportunity than paying down debt. And two, the companies are considering debt to be expensive at the moment and thus choosing to pay down with their free cash flow positions. So does that mean it's a bad thing? Well, not necessarily, but having the investment opportunities that stack up in the medium term would, of course, be a continuation of a lack of investment that has been a UK problem since 2007. So we need to make sure we've got those investment opportunities. The net flow of sterling money, known as M4EX, continued to be volatile month on month. M4EX rose by 7.2 billion in February, compared to a flow of minus 0.2 billion in January. This was mainly driven by households' holding of money, which rose by 6 billion in February, which is down from a 6.6 billion increase in January. I like M2 as the proxy for the money supply conversation, to be honest, because it's much easier and more simple. But look at the net flows of money to households over those past 2 months. It is significant, and let me tell you, inflationary. The money supply is considered by some schools of economics to be a much better predictor of inflation because money needs to find a home at the simplest level. Where will that home be for households? More on that when we analyse the ONS report in a short while. The flow of sterling net lending to private sector companies and households, M4LEX, amounted to minus 15.8 billion in February, down from minus 3.2 billion in January. This was mainly driven by a further decrease in the flow of lending to non-intermediate other financial corporations. So, less lending to the middlemen, less lending pertaining to the same logic as the point on repayments above. We generally need lending for growth, but price does matter, of course. Fiscal drag will be lower, but investment will be lower, and that's not good in an environment where investment is already too low. So my point about the healthy market is made by this week's graph. You'll have to check my LinkedIn or the Partners in Property website blog to see that graph, but it shows you between 2014 and the end of 2019, which I would characterise as a pretty functioning, fairly stable market. Yeah, sure, with a few bubbles in a couple of places, but that's always the way. Anyway, there's a few more points that didn't make the bank's headlines, but I believe we should be aware of. The effective interest rate, the actual interest paid on newly drawn mortgages, fell by 29 basis points to 4.9% in February. The rate on the outstanding stock of mortgages increased by 7 basis points, from 3.41 in January to 3.48 in February. So that first bit did make the bullets, as you know, but it needs to be put side by side with that second bit. So the real cost that the UK is currently carrying in terms of mortgage debt is 3.48%. If those mortgages all started in February 2024, that rate would be 4.9%. Some people would be broke, some properties would be sold. It doesn't happen overnight. But that's a 41% increase or a 29% discount if you invert it. While that existing debt number is rising towards the new number, which it will every month until those numbers invert their position, by about 2% a month. Again, that makes sense really, because in a 5-year cycle, 1/60th of all mortgages would drop off each month. It isn't as simple as that, of course, but there is enough truth to it. That lag continues, and my point would be that 70% of impact of interest rates has already been bedded in, as quoted by the Bank of England, is nowhere near 70% in this part of the market, more like less than halfway. But then look at this household arbitrage situation, which is one reason why the households are doing okay, or even well, thank you very much. Yes, averages are dangerous. Yes, some people are struggling. No, I'm not trying to minimise that. The effective interest rate paid on individuals' new time deposits with banks and building societies fell by 7 basis points to 4.46%. The effective rate on the outstanding stock of time deposits increased by 5 basis points to 3.81 in February, and the effective rate on stock sight deposits also rose by 4 basis points to 2.11. So newly drawn mortgages 4.9, newly deposited funds 4.46. That's some razor thin margin right there, 0.44%. People are currently able to invest at a higher rate than they've borrowed on average, although taxation likely puts paid to that being an arbitrage situation, but you can see how helpful that is. So let's look back in anger for a moment. Pick 5 years ago as our typical mortgage cycle. February 2019's report. The sad news is the Bank of England weren't even tracking those metrics 5 years ago in these reports. Mind-blowing in a way that even at the top level of government and NGOs, we still tend to be reactive rather than proactive. I can throw a dart at it though. Average rate on newly drawn mortgages back then, I'm going to say 2.7. Average debt stock is more like 3%, not vastly different to now. That number going downwards, not upwards, because the new debt number was lower than the existing number, because bond yields had been falling. That does, if I'm right of course, put much more into perspective just how little has really changed, in spite of interest rates going up quite so much. This all only applies to those with fixed debt, of course, because those on variable rates have taken the full force of the rates moving. Next, the change in lending. The annual growth rate of borrowing by large businesses was 1.4% in February, up from 1.2% in January. The growth rate of lending to SMEs decreased slightly further, from minus 4.8% in January to minus 4.9% in February. What we already always know, the smaller businesses can't get the money when they need it, and with reduced margins they can't borrow their way out of the hole. But it becomes a self-fulfilling prophecy. This is why funding for lending existed in 2012, and also why more initiatives are needed to help businesses out of their post-COVID holes. Here's why. The average cost of new borrowing from banks by UK PNFCs, that's non-financial corporations basically, fell by 4 basis points from 7.01 in January to 6.97 in February. By contrast, the effective interest rate on new loans to SMEs increased by 5 basis points to 7.55% in February. Half a percentage point premium for being small, but that's rising, whereas the bigger borrowers are paying a bit less. That's some increase though on their old rates. Their existing stock of debt number isn't a known number, more's the pity by the looks of it, but you can see they are sitting 2.5% or so above the newly drawn mortgage rates. So as the monetarists will tell you, money supply goes up, money needs a home. The money supply, after being trimmed, is going back up. Does quantitative tightening affect this? No, but the lack of easing does. In tightening, the bonds are sold into the secondary market. They're not retired. Some are retired, the same number that are being retired since before the last round of QE. So some of the government bonds that were issued, that were bought by the Bank of England in that effectively paper transaction in order to pump more money into the economy, some of those are allowed to expire at the end of their term, and that money doesn't reach the broader money supply. Whereas if we're selling the debt, which we are in quantitative tightening, into the secondary market, that money still exists within the system. Are you confused? I don't blame you. So the point really is that the money and the interest is going somewhere else rather than to the Bank of England, which is effectively going to the Treasury. Has that helped yet? But money supply down, that was the action that was needed to see inflation coming back into line, has been happening since October 2022. It's flatlined a bit now after hitting a bottom in October 2023 and isn't yet on its way back up properly, but it is about where it was in March 22, which was up about 22% in 2 years. Pretty much the inflation that has played out now in the period since pre-COVID. I'm still watching it closely month on month. It compares favourably to the US, who pumped theirs up 40% over the same time period, and it stands to reason that they have more secular inflation to deal with than the UK does. But the numbers are still just too high in services and wages for comfort. Let's ensure to watch the money supply over the coming 6 months very closely, but this is a point where the UK and the US can and do diverge based on this underlying point. So I hope you enjoyed the turbot. Now for the steak. The meat from the quarterly ONS household accounts for Q4 2023. The ONS are lagging on a lot of this stuff with no release dates ready for things like household balance sheets, which I like a lot. But perhaps this is another methodology change. I can't find any communications about it. Anyway, the quarterly sector accounts come out around 3 months in arrears, at the end of the next quarter basically. Headlines and analysis first. The household saving ratio is estimated to have increased to 10.2% in quarter 4 from 10.1% in the previous quarter. This is a big number in percentage terms, but recessionary noises may have forced it up rather than down. Pre-COVID, it looked more like 5%. In better times, 7 to 8% would be average. The increase in the savings ratio was driven by a rise in net social benefits other than social transfers in kind of 3.9 billion, together with increased employers' social contributions of 2 billion and wages and salaries of 1.4 billion. That's likely warm home payments and also second instalment of cost of living payments. That was £300 per household for qualifying households, alongside wage rises, of course. Real households' disposable income, RHDI, is estimated to have grown by 0.7%, following broadly flat growth in quarter 3, 2023. Still moving forwards, not backwards, with a major increase coming for H1 2024 in my opinion, and from the figures that we've seen thus far. Within RHDI, nominal gross disposable income increased by 1.1%. Not bad for a quarter, but less than might have been expected. The UK's borrowing position with the rest of the world as a percentage of gross domestic product is estimated to have increased to 3.3% in quarter 4, from 2.9% in quarter 3. This is an interesting angle. Of course, when the Bank of England owns the debt and isn't selling it off as part of the quantitative tightening programme, then it isn't overseas, whereas selling it off likely does send it overseas. Is this uncomfortably high? No. Indeed, I'm sure we'd love to send more overseas. The US proportion of foreign-owned debt is 10 times this, 33%, as they are the global reserve currency. Non-financial corporations increased their net borrowing to 2.7% of GDP, from 1.5% of GDP in quarter 3 2023. This was driven by falls in gross operating surplus of 4.2 billion and net property income of 3.8 billion. More borrowing last quarter, but less going on at the moment, as we've seen in the more real-time report from the bank. Households decreased their net lending to 2.9% of GDP in quarter 4 2023 compared with 3.1% the previous quarter. This was driven by falls in net capital transfers of 2.8 billion, the adjustment for pension entitlements of 2.7 billion and net property income of 2.4 billion. Paying down and borrowing less as the price was high, basically in sync with the Bank of England analysis. General government saw a decrease in their net borrowing position to 4.6% of GDP in quarter 4 from 4.8% as a percentage of GDP in quarter 3, yet still borrowing as always. So the biggest factor for me here is RHDI. I adore RHDI as a metric because it is the households that rent properties, not individuals. If there are more people in the household, the rent paid per capita is also lower, effectively. Now that's a very sterile view, of course, typical economics. If it means people over-occupying properties or having flats instead of houses because they are cheaper or otherwise, that's a sad state of affairs. That's also been the state of affairs in the capital city for at least a decade, if not more. Grenfell spoke volumes in that department, and the situation has worsened significantly since then, particularly in the past couple of years. However, in the absence of a better metric, and my argument is that RHDI per capita is not that better metric for our analysis purposes, RHDI is my favoured one for economic health and affordability. Households and their ability to afford rent and the pace of the increases has no better proxy. The average is always dangerous. How is it in your part of the country, for example? We still await the regional GDP figures for 2022, unbelievably, although they were also supposed to be released last month. But with the low paid being the only ones to have actually benefited from this parliament, according to the data, and there is a link in the blog for the Spectator website, which has a great interactive GIF graph, which you can take a look at. That's in real terms adjusted by CPIH, so that's the Consumer Price Index with the housing element put in. And you could argue that doesn't work because the real inflation rate for the poor has been well above CPIH because the cheapest items in the supermarket are up by the largest percentages, for example. So it's either the lower paid or no one at all. I feel somewhat justified though that this helps the renters. The real situation isn't quite as bad as the graph, since average household numbers have grown quite considerably, spreading that rent burden among more household members, and the council tax, and the energy bills, etc, etc. It's moved up nicely in 2023, RHDI, and it'll move up even more nicely in 2024. If I'm wrong about inflation and it is quenched, wages are notoriously sticky, and with a 4% target on national living wage in 2025 already in the mixer, if inflation is 2% or under, that's another 2% plus on real household income. Certainly at that income level, anyway. For the rest of this year, if I'm right, with inflation at 3-ish and wages at 5-ish, and those are my predicted averages for the rest of the year, that puts another 0.5% per quarter on RHDI, on average at least. Unless households start to get smaller again, but that would require, aside from anything else, net migration to come right down. April's figure will have a nice bit of growth in it thanks to the national insurance cut too. That might be worth another 0.5% or more. I thought it might be worth more like 0.8. The OBR have revised their net migration estimates from 250,000 to 290,000 to 350,000 per annum now over the forecast period. That's 5 years. The ONS estimate 315,000 per annum from 2028 onwards. Both of these don't seem to put enough weight on the post-COVID net migration statistics, but there have been significant changes in March on migration, which do mean that 300,000 people, according to the Home Office, who migrated to the UK last year would not have been able to do so if all of the changes from May 23 and December 23 had been enforced by then. If that is true, that would send net migration down towards the numbers that the OBR and ONS seem hurriedly revising up towards. But all of the previous house building estimates have been based on circa 250,000 net migrants per year, not circa 350,000 or more. The number coming out of the think tanks is more like 400,000 plus. The newer house building estimates factoring these figures look like more like 500,000 per year or more being required, based on lags thanks to COVID. And starts have not yet really got started again, and these larger net migration numbers. The problem of suitable stock just seems to get bigger and bigger as time goes on. So this week I asked myself, so what? What's the overarching point of all this? Why all this deep dive into the data? Well, it enables me to be able to put together, I think, going into quarter two, a nice tidy 10 bullet point summary for you. Number 1, real household disposable income is going up and up nicely. Affordability ceilings are really some way from being breached. Number 2, house prices need lower rates to really start taking off. All that can drive them forward at the moment is slightly cheaper rates, a fair bit cheaper than last year, and wage increases thanks to inflation. We also need the election out of the way, regardless of the winner pretty much. What we've got is still enough to drive them forward, not backward as many of the bears have predicted. Yields, therefore, are still climbing because ultimately rents are going up faster than house prices. This change isn't as fast as last year, but they're still ascending rather than descending. The supply problem that we all suspected would never be fixed anyway is further away from being fixed than it's ever been. Instead, people are taking it upon themselves to form larger households in existing buildings and overpopulate buildings. Inflation isn't dead at all. Once energy price cuts drop out the figures in July, we're right back on the climb, and tax cuts and wage rises to the level we've seen in April are inflationary on their own anyway. Rates can stay stronger for longer because the underlying economy is actually doing okay, in spite of the fact that the government has at points looked totally feckless when trying to manage fiscal policy. I'm not talking about Sunak and Hunt there, but I'm talking about the others. It is cheaper to rent than to buy in certain areas. The bit that the press largely aren't getting, and many people are missing, is that a 25% price increase from 2020 is basically the baseline, and so everything needs to be viewed through that context and lens. The price of shelter has gone up significantly, like everything, but ownership has gone up more than rent has at the moment in some areas. Households are still saving, worrying about escalation in the Middle East and Russia, at least one of which took a riskier upturn this week, and there is widespread chatter now that Kyiv will eventually fall to the Russians. Investors are still selling more properties than they are buying, shortening rental supply even more, and arrears and insolvencies are up, but still under historical averages and at very manageable levels. Those trends need watching closely, of course. So these are all the ingredients, but what's the recipe? Well, you can either navel gaze and or wait for perfect conditions, or get on with it now. The future looks pretty messy from the tenant's perspective. From the property owner side of the equation, this is a Goldilocks setup. If you aren't spending time laying foundations now to build or expand portfolios, I'm not sure what you're waiting for. The perfect storm's already here. Waiting for lower rates will start to take prices away from you, as that is the final ingredient that's needed for the crack-up boom. The deals won't be as good then. They won't be as plentiful. The margins will get squeezed somewhere, and you won't have had that 5% or perhaps 10% where inflation has done the hard work before rates repricing really kicks in. The natural rate in this post-industrial economy without major change is 2 to 2.5% for base. That could be 15 years away right now, it could be 10. But when it's here with bond yields to match, oh boy. So congratulations as always for getting to the end. And don't forget our property business workshop on Wednesday the 24th of April. Any tickets for you or anyone you know who might want one are at bit.ly/PBWTWO, and we've only got 3 left. Onwards and upwards then as we blast through quarter 2. Make sure you keep calm and carry on, but not so calm you aren't being active right now. Thanks.